First Pacific Advisors is a Los Angeles-based investment management firm, and we have value that is pretty much the precept that drives the organization. The contrarian value strategy is a global strategy that can invest across the capital structure: common stocks, preferred stocks, junior debt, senior debt, bank debt, etc. And it gives us great flexibility to generate what is our goal, which is to generate equity rates of return while avoiding permanent impairments of capital. So as a result of this strategy, as value investors, we are perfectly content waiting on the sidelines until opportunity presents itself, which means cash can build. Cash will build as a default, not as a top-down market view. Over the last, drivers of return over the last year or so have been driven by us really shifting the portfolio. We found a lot of areas of the world have kind of come untethered, and we were able to sell that which was higher quality in our portfolio and had returned very well, and transition it to companies of equal or better quality at much lower prices, but where there's more bad news surrounding it. And in some of those cases, they're companies that are more cyclical. And in some of those cases, there are companies that are surrounded, the Asia, contagion that has begun to afflict, some companies in the periphery and in orbit of China. So we were able to buy Asian internet platform companies and be able to take advantage of dislocation in the market as people really hated them as these prices were deteriorating. Now, we didn't pick the bottom, as we never do. We were able to buy them as they went down, and that has been we're very pleased by that investment, despite some of them being underwater today, because we believe they offer great opportunity as time goes on. So as prices decline, we continue to buy more. Similarly, driver has been, other areas have been out of favor. Cyclical cement companies that we own that are global based, Heidelberg Cement, Lafarge Holcim. The cable companies in the United States, were out of favor last year. It come down a lot in price, including Comcast and Charter Cable. And those are businesses that are more levered financially, as well as some operating leverage. But there's bad news that surrounded the industry because of fears of overbuilding, because of fears of 5G, because of fears of people cutting the cord. And we can go speak chapter and verse as to why we don't share those same concerns, and that the price declines were not justifiable given what we viewed as the business prospects over the longer term. Those were some of the drivers, both positively and negatively, during the course of the last year. We are still positioned conservatively, although in the last year we've added about 10 points to invested exposure, because as we took advantage of weakness, particularly as we got later into the fourth quarter when the markets were unraveling. So we took advantage of that. That still leaves us with the high 20s and liquidity in the portfolio. It gives us lots of room to buy as opportunities present themselves in the future. Some stocks have got really inexpensive, we felt, in the fourth quarter, but since then, it's 2019, just in the first month alone was a good year. Stocks have rebounded dramatically, and prices therefore are not as attractive as they were. So we are now in the wait and see place where we're looking for more opportunity, which is really driven by price. We as a firm, as a team, tend to respond to price. We don't get to decide. The market offers us an attractive opportunity. We don't get to pick anything but whether we want to go in on a given day and buy company X, Y, or Z. We wrote a piece, penned a piece recently called "Risk is Where You're Not Looking," which addresses corporate debt and addresses it more from the U.S. perspective, but it's true from the European perspective as well. And there's been a proliferation of corporate debt. The U.S. market has just exploded. There's now over $9 trillion of corporate bonds, more than double what it was a decade ago. And the credit quality of that debt on average is about as low as it's ever been, and the covenant quality is about as low as it's ever been. And so with the low yields that are still offered today and the relatively narrow spreads to treasuries, it's not an attractive risk reward. So we sit on the sidelines and wait for that opportunity as well. So for us, we have a lot of tools in our tool chest. We're unusual in that way. We can do a lot of things, but just because we can do a lot of things doesn't mean that one should. So if you're a hammer, everything can't be a nail. And so we're waiting for the appropriate time to re-enter high yield. And at this point in time, there's been very, very little to do. On the corporate side, we have one investment we made was the debt in municipal debt in Puerto Rico. I've never owned a municipal bond in my life until the end of 2015. And Puerto Rico is a good investment for us. And it also, to go back to your earlier question, a driver of return in the last year. Very additive.